Hey traders, Raghee here. Welcome to Charts and Coffee on this non-farm payroll Friday. Got a lot going on today in terms of reaction to a massive macroeconomic data release. For those of you scratching your head, wondering why the heck would the market head lower on a, 372,000 NFP when we were looking at 368 as the consensus, as the expected number. Why would it move lower? And the reason it moves lower is because this is not about simply whether or not this was better or worse than expected. This is a macroeconomic number that tells us, why that reaction. The Federal Reserve is looking at that number. Jobs are fine. Why not continue to hike rates? This is the opposite of, we want the Federal Reserve to go slower and remain on the target probability lower. This is the opposite of that. And that's why we get this bearish reaction. By the way, for those of you that just rolled out of the live trading, day 2, we had a bonus session this morning. We live traded the NFP number. Through the process, directional bias was bullish, parked limit orders to buy, HPMRs were hit, had a nice quick move to T1, break even stop, and we were done by 12 minutes after the event. And now we're flat, waiting for this echo event to happen once the bell rings here in about 28 minutes. So really, really a fantastic morning so far. And let's see what else we have today on this caution day. So already some nice NFP. NFP trading is not something that I would recommend to be a place where day traders begin. But when you have the understanding of directional bias, these intraday sentiment reads, when you have these volatility and time-based support and resistance zones that you can use to find the market edges, it makes a huge difference, as a lot of our traders just found out. So very, very excited about that, and super excited as always to take your questions. So let's go ahead and get into those. Let me grab this window and sort of get it out of the way so we can make room for the questions. There we go. All sorts of window adjustments here. There we go. Perfect. Okay, so let's go ahead and dive into it. What is my bias this morning? So, Vi, our initial bias on the morning was bullish for the NFP. And as we are going to retake that reading, closing in at 9:30 Eastern, it's going to be mildly bearish. So bullish this morning, actually a little bit bullish, hence the long trades we took initially on the NFP, just that quick reaction. We're not looking to take any kind of big read assessments of the overall trend at 8:30 and change in the morning. So now as we get closer and closer to 9:30, it will be a little bit more bearish. So great question. Thank you very much. Next up, Nancy asks, I'm curious why the market seems to be responding negatively when the employment news seems to be somewhat better. So Nancy, thank you for the question. Again, I think a lot of folks are wondering that. So kudos. I think that's a very common understanding of data. And I hope that the explainer that we kicked off the session with made sense. And again, just a Cliff Notes version of that. Why is the market disappointed, lower, on what seems to be 102,000 better than expected non-farm payroll print? Remember, gang, when we're in a tightening cycle and data is stronger for growth and for jobs and flat or weak for inflation, it's going to give the Federal Reserve a green light to continue to hike rates, maybe favoring the 350 to 375 target rate as opposed to 325 to 350, right? So data, release by release by release, gives us a trend, and the Federal Reserve is watching that trend. Usually a 4-week rate of change, just some sort of relative performance from where we were and where we are now. And this kind of number tells the Fed, hey, we can keep going and probably favor more hikes. Not probably much more than again, what's already been discounted, but they can favor that more hawkish side of the zone that they're in. And my Sector Secrets Mastery folks, if you have not watched it yet, those of you that are here in Charts and Coffee, shout out to my sector think tank. Watch the video I sent you yesterday. Probably one of the most important videos that I could cut regarding how a bottom is going to form, where we are within that transition, that process. And most of you will probably know why the market did what it did today based on that jobs number. So check that video out if you haven't already. And if you don't have access to my content, the free video that I cut yesterday, right here at the Simpler Trading YouTube channel, that's going to give you a Cliff Notes version of that bigger conversation. Please do check that video out. It explains, what do we call it? We got kind of funny with the title. The light at the end of the tunnel? No, the light at the end of the bottom, and how that ultimately looks. And for those of you wondering, at what point do I start looking optimistically, longer term time horizon to the upside? Check that video out. If you have any questions, leave those questions. So Mark, in the video, bottoming process. Check that video out, Mark. I think it will absolutely give you all the different cues. If you're, again, if you're a member of the, and everyone here listening, if you're a member of the Mastery or the Futures Room, check out yesterday's premium video. Everyone else, check out yesterday's free video back at the Simpler Trading YouTube channel. All right, next up is I'm holding 3 SPY puts that you bought Thursday, expiring the 11th. I typically don't hold weekends. I can't, so CDN's asking, so CDN and bell hasn't even rung. I would make, there's no way that I'm going to be able to tell you what the general sentiment is. You want to keep an eye on certain markers, right? If we're going on a long distance drive, I know when my husband and I occasionally drive down to the Keys, mile marker what? Mile marker what? You gauge your process. We have sort of mile markers in trading as well. They're support and resistance levels. I would be much more interested in remaining below the line in the sand. All right. Remaining below the line and the sand. And also, where are we the last, say, 60 to 90 minutes? Where are we in the afternoon session? What is the closing sentiment? The opening sentiment is not necessarily going to tell you whether or not to hold through the weekend. That closing sentiment is. Why? Because we don't fade Fridays. So I would keep an eye on that closing sentiment. All right, next up, do I anticipate, Martha, it's interesting. Would we look for the echo to the up or downside? When I say echo, I believe at 9:30, it's going to look a lot like 8:30 did. We might have an initial reaction to the upside, then we could have a move lower. These are just tendencies. They're not trades, but yeah, I would look for something along the lines of a similar type reaction. Okay, yes, I would look for a similar type reaction. All right, next up, we've had an active hot zone week. Yes, we sure have. How often do I update the HPMRs after each data release? So MVC Chief, what we do, Lorna and I, is we have basically a gauge of how much volatility has to move before we can justify a move, because you can over-update HPMRs and certainly you can under-update them as well. So after this event, it's not just the hot zones, right? It's the ranges that are put in, to your point. So if these ranges, we see a significant expansion or contraction, we will re-update them. We just did them in July. And so far, I have not seen that needle move. And it's not after each data release. It's after contractions or expansions in volatility that tell us it's time to move them. Because again, you can move them too often, and then you're going to have an overly sensitive HPMR. It's kind of hard to do, but there is a gauge, and so far, no, it has not moved enough. All right, right around 7:55 a.m., the S&P turned around, inching higher. Well, I'm not going to look at the SPY at 8 minutes to 5 a.m. Eastern, or I'm assuming that's Eastern AA. S&P is the short the rip after the NFP. Is this a short the rip after the NFP print? My initial trade was a buy. We got long, so that nice little move higher, executed the target, put in a break even. So now is there a possible short the rip? I'll have to get that set up. We haven't had that set up yet. We have not had that set up yet. So again, for right now, the near-term sentiment is weak right now. And that was not the case just 40 minutes ago, really 50 minutes ago when I was doing the bonus session for the class. All right, next up is, let's see what we have here. Bear with me, gang. So, Central. So 9. Okay, let's go take a look at the ES. Now, remember, gang, the HPMRs did not look like this with non-farm payroll. They reacted to the volatility, and they've moved the way they've moved now. So 8:55 a.m. I'm sorry. So that was Central. Okay, so 8:55 a.m. Was there a setup there? No, not for me. No, not for me. Set a short the rip. I'm not. So my general rule is this. We just had. So I'll give you an idea of what we did. So you can get an idea of this candle here. Moved into our zone. We had an aggro and moderate. And the very next candle, the 8:35 candle, hit our first target. In some cases, the moderate entry took us from 82 to, what was it, 92? So, I mean, these were, in many cases, 8-10 point S&P trades within the matter of less than 5 minutes. So now I need a new setup. Now I need market structure. Now I'm going to start all over again. Now I'm going to start with a fresh set of eyes and a clean slate. And so based on that, I need a standalone setup, and I don't have that on the S&P right now. And if it's not on the S&P, for me, it won't be on the ES. If it's not on the ES futures, it won't be on the SPX. It won't be on the SPY either. Okay. All right. So next up, if the non-farm result is optimistic, signaling a hawkish Fed, why has the Fed fund futures switched 90% on the 25 to 50 basis points? So it's not just, so Julian, when we look at and I frankly have not dove into that yet. I was live trading that one. So yeah, let's go take a look. Sure. So here we are at the rate hike expectation, right? 225 to 250. It's not really that different than what we've been expecting, right? I don't see a lot here that's changing. No, what's happened? So Julian, again, we have to be specific to the contract month, right? No, actually, when we get out to December, which is the month that matters now, frankly, where are we at year's end? We've been neck and neck with 3.25 to 3.5 to 3.5 to 3.75%. And for a while, 3.25 to 3.5 was leading. No, this has actually done exactly what I said. It's green light the Federal Reserve to, if they want to, be slightly more hawkish. The market is taking back, or I should say adding on, that quarter point that they had taken back. There was a slight expectation for the better part of a week that we might see 1/4 point less hike come December of this year. That's very, very slightly being taken away as the 350 to 375 column is taller, right? Is larger, higher percentage than the 325 to 350. So nothing in that regard as far as the ultimate target for the target rate probability has changed. So this is not a more soft or less hawkish look at all. In fact, it's just the opposite, but not by a lot. So whether or not we hike a little slower, whether or not we hike, and again, whatever these near-term columns do, to your point, whatever these near-term columns do, you're right, it could be a little screwy. But right now, and if you watch the video that I cut yesterday, this might make a little bit more sense too. Right now, the main thing is that 350 to 375 column in December still leading, even if by a little bit, still leading. The path between now and December is probably less important. Whether they hike 75 or 50, that shock, it's out of the way with that first 3/4 of a point hike we got in June. That shock is out of the way. Now it's where do we see the target rate leveling off? So that's why I mentioned in that video, it's a little bit different. I'm not really concerned month to month. I'm really much more interested in how do we end the year, and are we still talking about roughly 350 to 375 or 325 to 350? So thank you for the question. Good for looking at that stuff. A lot of folks don't pay attention to those things, and then they wonder what's happening. Remember, gang, the most important influence on the market, it's not earnings. It's not television. It's what the Federal Reserve or central bankers in general are doing with monetary policy. And that is the most important macroeconomic factor. However, under that is what are important macroeconomic factors to their decision-making process. And that, of course, is jobs and growth and inflation. So terrific question. All right. So yeah, I wouldn't worry too much about what July is doing as long as where we end up come December is still the same story. So the path may change a little bit. This is true. We might see some adjustments to what was once maybe a 75 basis point hike expectation to 50, et cetera, et cetera. That only matters if we're not still expecting 350 to 375 or even 325 to 350. And that has not changed. Until that changes, the path to December is probably not as important as it was when we were in the tightening cycle starting in May, right? So that has adjusted in terms of the psychology. All right, let's see here. We've been talking about a bear market. Well, not me, for the past few months, and what it means in terms of numbers. Well, again, it's hard for me to jump into that topic because that's not something that I've been doing personally. I don't care what I know a lot of people, to your point, you bring up such a great psychological point. If the markets are down a certain percentage all of a sudden on television, which I find absolutely just entertainment only, we know that we're in a bear market. We're in a recession. I try to keep reminding my traders, we don't trade psychological realities like that. We trade trends. But you're right. We've had a downtrend in a quote unquote bear market. So what would it take to see the bulls take back control? Awesome question. So first of all, I don't care about recession, and I don't use these odd little descriptions of, 5% is okay, 10% a retracement, 20% a crash. It's just so arbitrary. But to your point, that's a broader psychological understanding. We know downtrends will typically accompany that. We focus on structure, and that structure and psychology will usually made up pretty well. If you're interested in what's it going to take, check out that video that I posted at the Simpler Trading YouTube channel. It runs. So I know I've mentioned this a few times here, so let me just show you all here. So head on over to Simpler Trading. Here, let me see if I can't pull this up here before we wrap up the show. So go to the YouTube or just Google Simpler Trading YouTube. However it is you get to the Simpler Trading YouTube channel. Okay, so there it is, Simpler Trading YouTube. Bam. Next, what do I want to do? Well, here's our Charts and Coffee show that's happening right now. Scroll down. Okay, yesterday, this video here ran 8 minutes and 2 seconds. Futures trading, the futures trading update, light at the end of the bottom. I am looking at a bottoming pattern happening. It's going to light at the end of the tunnel, right? A lot of us are wondering when can we start thinking a little bit more optimistically longer term. I believe the time has come. Check that video out. It runs 8 minutes. It's going to go into a lot more detail than I have time here in the show to get to, but check that video out. It will absolutely explain why, gang, it's never about whether or not the Federal Reserve is right or wrong. We don't get paid to judge them, right? It's not a matter of whether or not we think there's a top in inflation or not. A lot of traders like to front run this stuff. That doesn't matter either. I show you that there are certain markets that are behaving at certain price levels that do suggest that the worst is worse, meaning pullback, and that power band of Fed hawkishness is pretty much done. All right, so check that video out, light at the end of the bottom. I think it'll be absolutely an eye-opener. And thank you, Robert. Thank you all for joining us each and every morning here at Charts and Coffee. Yes, thank you for smashing that like button. If you have questions Leave them below. Comments, feedback, requests. I do check them out. Trish and I check out the comments for all the videos that are posted here at Simpler on a regular basis. They are absolutely read. You'll notice sometimes I respond. So if you have any questions or comments, leave them below. Smash the like button, and I'll see you on Sunday for our weekly notes live show. We'll see how this Friday winds up, winds down, however it ends, and we'll take it from there. Be good to each other, gang. I'll talk with you soon.